Welcome. You are now linked to your Telecom retirement.
Hey, how are we doing today? There are a ton of myths out there. And I want to talk about tax myths today, but just a quick myth story. I had a weird childhood. I guess everybody had a weird childhood because there's no such thing as normal. Normal's a setting on your dryer type of thing. I was a voracious eater of facts as a child. And I'm talking like 8, 9, 10 years old. It got bad. I think I've mentioned this on the podcast before. My grandmother, Mimi, my mother's mom, and I love my mother's mom. She was the best. But she had a little bit of a cruel streak to her. She would call me, Dennis, you're just Mr. Perfect, because they'd say something and I'd say, actually, that's wrong. It's this. And she'd just turn around and look at me. So I was probably 10 or 11. She bought me this black t-shirt that she had. Remember back in the 70s, they had the, you could get t-shirts with writing, but they'd put the letters on and, they basically iron on letters. It was iron on white, those velour fuzzy letters that said Mr. Perfect. She bought it as a joke. Oh, I wore that shirt. I wore the heck out of that shirt until I wore it out. It's like, yeah, I'm going to take this mantle. My mother, again, one of those things, called me, do you remember the Shell Answer Man? I loved the Shell Answer Man. I was called the Shell Answer Man, but Shell did these commercials back in the late 70s that they were teaching different things about driving. The two I remember distinctly. One was they had two cars. They had a red car and a yellow car. The red car was going 70 miles an hour. The yellow car was going 55 around a track. Exact same car, exact same amount of gas. And the red car ran out of gas sooner. And I remember it's red because I didn't like yellow. I hated yellow as a color. I don't know why. And wanted the red car to win. And obviously it wasn't going to win because it was driving at a faster speed. The other one was when you come up to an intersection, a T intersection or a crossover, is look left, look right, and then look left again. And the reason is that the traffic coming from your left in America and the places where we drive on the correct side of the road is those cars are going to hit you first. So you want to look there just one more time, just to make sure somebody's not going to cream into you. And so my parents called me the Shell Answer Man. But I remember I was probably, it was college. I was probably 19, 20 years old. I'm home. It's Thanksgiving. Thanksgiving's coming up. I love Thanksgiving. And my sister said, yeah, it's always funny that you get drowsy on Thanksgiving. It's the melatonin in the turkey. And I froze and I turned. And keep in mind, it's not today when we're dealing with facts today that you could just go on the internet. You can watch YouTube videos or be on Facebook or Instagram and gather all this data. I'm gathering this data from magazine subscriptions and doctors' offices and things of that nature. That's where I'm coming up, and I'm trying to just fill my brain with these things, and it's still full today. And if you want to be smarter, just read as much as you can, read as much as you humanly can. I don't care if it's a magazine or fiction or nonfiction. Try to be nonfiction, but the more you read, the smarter you get. Period. End of conversation. Don't watch, don't listen, read. Even though you're listening here in this podcast, listening is good. Reading is better. So I turned to my sister and I said, that's not even remotely true. Nope. That's what I read. I heard that. That's what I did. And we started having this little discussion. My sister is 6 years younger than me. I'm pretty sure she could take me in a fair fight, just because she's that aggressive. And I love that about her. She's aggressive in ways that I'm not, that I wish I was. And we're going back at it. And my mother jumps in. No, I think she's right. I think she's right. I heard that. Like, facts are now get to be voted on. Although in 2024, I guess we do a lot of times vote on what we consider truth. It wasn't melatonin. It's tryptophan, by the way. And I told them that. They didn't believe me. It's not the tryptophan that makes you sleepy. My argument back then was, listen, if the tryptophan in turkey, not melatonin, made you sleepy every time you had a turkey sandwich, you'd be sleepy. If you had deli turkey, no, that's different. It's the same turkey. The reality is, in case you're still believing this myth that it's the turkey that makes you sleepy on Thanksgiving, it's the mashed potatoes, it's the sweet potato casserole, it's the pies, it's the stuffing, it's all of the carbs and sugar that makes you sleepy, not the turkey. Eat more turkey, eat less of those things. You won't be sleepy on Thanksgiving. I like being sleepy on Thanksgiving. I cook Thanksgiving. So taking a nap after I've cooked all of that food and eating myself silly is one of the highlights of my year. So without further ado, I want to talk about 7 tax myths. And these range anywhere from the macro to the micro. It really depends. And I'll hit the first 2 just because they're top of mind and they drive me bonkers. And they're dealing with, there's a lot of, as I'm recording this, we're still before the election and we still don't know who's going to get it. And there's commercials. And I live in Massachusetts. We know who Massachusetts is going to vote for, but TV signal goes to New Hampshire, and New Hampshire is still kind of somewhat on the fence. So we're getting the political commercials. And one politician says, billionaires don't pay their fair share in income tax. Now, I don't want to sound like I'm for one candidate and not for the other. This is the reality, is people ask me, Dennis, do you watch the State of the Union? Or it'll be the next day. Hey, did you watch the State of the Union? No, never have, never will. I think I watched maybe parts of the one after 9/11, that following year. Other than that, I've never watched one in my entire life. And clients can't believe it. Are you serious? You don't watch that? Nah, I read about the highlights the next day. Again, that whole reading thing. They go, why don't you watch? I said, oh, there's only 2 things that can happen. It's a candidate I'm not really, it's a president I'm not really crazy about. And they're going to lie. They're going to get up there and they're going to lie. And that drives me bonkers. I said, but there's one thing that's even worse, is it's a candidate that I tend to agree with. And they get up there and they lie. And that drives me even more bonkers. It drives me absolutely crazy. I hate that. I hate that politicians lie, but politicians lie. That's what they do. So this is a big fat lie. Billionaires don't pay their fair share. And you may have seen this a couple of times here and there. I'm going to give you some facts behind this. Billionaires definitely pay their fair share when the left, I'll kind of point it there, is they're doing a good job of trying to divide America to gain votes. And both parties do it. So I'm not going to say that they stink and the other ones are great. They all do it. So just there. But let's explain it in a way that it looks like those people are getting one over on us. And they're not. I pulled up some information from the Tax Foundation. Tax Foundation is a group that kind of consolidates tax data. And the latest data they have from the IRS is from 2021. In 2021, the average tax rate for across everybody, if you take the average paid, is 15%. So the average American pays about 15% of their gross income in federal income tax. The top 1%, so that's I think these days it's either $250,000 or $300,000 in income and above, they pay 26%. The top 1% makes 26% of the income as well. Just a coincidence that it's the same percentage. They pay 46% of the total taxes. 46% of the taxes are paid by the top 1%. It's hard to say they're not paying their fair share when 1% of the people are paying almost 50% of the taxes. They're definitely paying their fair share. Another thing, just a side, is I was looking through this data. The top 50% of earners pay 98% of tax. And I've talked about this before. I think that's dangerous. Even if they're paying $1, I think it's important for just about every single American to pay something, because if you're getting something for free, you don't value it as much. And trying to figure out ways to just have people pay a modest amount. There's nothing wrong with that. There's nothing wrong with, it's just like if you were mowing lawns or babysitting as a kid to save up money for something, that something had much more value than something that was just given to you at Christmas. So be aware of that. Second one that kind of goes along the same vein, not as common that I hear recently, but definitely want to go over, is corporations don't pay enough in income taxes. Corporations don't pay income taxes. And people look at me like, no, of course they do. Of course they don't. They do not pay income taxes. Corporations, they might pay a small amount of income taxes, but ultimately corporations do not pay income taxes. Who pays those income taxes? Consumers do. You do, and I do. If we increase the taxes on Walmart, do you think their prices are going to go up? One of the ones I was thinking about was it's been a while since the gas taxes increased in Massachusetts. And I'm very anti-tax, but it's been like 25 years. It's been a long, long time, I think, since the last gas tax increase, I think. But if gas was $2 a gallon on Friday and it is enacted on Saturday and it's a dime a gallon, on Saturday when you go to the gas station, it's going to be $2.10 a gallon. It's that simple. You don't expect it to be $1.95. You don't expect it to be $2.05. 100% of that tax is going to be borne by the consumer because the corporation's executives are not paying it. They're not going to pay their employees less, and they're certainly not going to pay their shareholders less. Taxes are borne by consumers. Consumers pay income taxes. And that's kind of a surprise to a lot of people, is people will say, well, if we just increase the taxes on corporations, we could solve this problem. You could, but you're solving it on the backs of the people that can least afford it. Because again, look at that Walmart example. Let's say we increase Walmart's taxes astronomically to pay for something. Well, they increase the cost of their goods astronomically. Who does that impact the hardest? Not the millionaires, not the people making $150,000 a year. The married couple making $50,000 a year or less is the most impacted. The person you are directly trying to help is actually the one that's going to pay for it in the first place. So we want to be careful of that. But let's talk about stuff that may show up on your tax return and stuff that may affect you specifically. Interest and dividends are not taxed the same. And this is one that people get wrong all the time, is I have interest, I have dividends. They're the same. They're not the same. Interest is taxed like ordinary income, unless it's tax-free interest, but regular ordinary interest is taxed at ordinary income tax rates, which means it's taxed at your highest marginal bracket. Dividends can be what's called qualified. And I love that with the giant air quotes, qualified dividends. Qualified dividends are dividends paid by a U.S. corporation for a stock that you've owned for at least, I'll call it a half a year. It's this convoluted, you've owned it for 61 days, past 121 days of, it's this long formula. They could have just said 6 months and it would have been so much easier, but there's this long formula of how long you've held it. If it's paid by a U.S. corporation and you've held the stock, or the mutual fund you own has held the stock for at least about 6 months, that dividend is taxed at capital gains rates. And you say, yeah, how big of a deal is that? Well, if your marginal tax rate is 10 or 12%, your capital gains rate is 0. If your marginal rate is 22 to 35%, your capital gains tax rate is 15%. Oh, wow. Dividends actually are better than interest, all things being equal. Now, there's problems with dividends of you're buying into corporations versus possibly something that's government guaranteed or backed by a FDIC coverage or something like that. But dividends can provide a lot more after-tax income for you. This will not apply in an IRA, so be aware of that. But dividends and interest are taxed very differently, and you want to be aware of that because you can put more money in your pocket by doing so. This is one I bump into. Number 4, I bump into this a couple times a year. And the great thing about this is, remember the Prel? I think it was Prel. Back in the late 70s, I used Prel. And I told 2 friends, and they told 2 friends, and so on and so on. I can spend less than a minute when I finally get to the explanation and stop all this jibber jabbering. I can spend less than a minute explaining why you should never think that mortgage interest is a good deduction. And not only will you know it, you will know it to your core, to the point at which whenever you hear somebody say it in a cocktail party or at a family gathering, you can say, that's actually not true because, and you can reiterate back in about 30 seconds to a minute why that's a dumb idea and they should not believe that. And now that person owns it. And it keeps going and going and going. And I am like on a one-man quest to tell as many people as possible. So here is your time that I'm handing you the bottle of Prel and saying, you're now going to go tell 2 friends. So we have various tax rates. We have, they go 10, 12, 22, 24, 32, 35, and 37% income tax rates on the federal side. And I remember, again, I was 10 or 11 years old. Again, I was a weird kid. And back then, my dad would do the income taxes on the dining room table. So it would be usually Sunday. We'd eat Sunday dinner a little bit early, and he would lay out everything. And it was covered. The dining room table was covered. So we're talking like 81, 82, 83, definitely pre-Tax Reform Act of 86. And at that time, there was a whole bunch more tax deductions you could take. So not just mortgage interest was deductible, but interest on credit cards and car loans and personal loans and a whole bunch of other stuff was deductible. So my dad's got this sea of stuff in front of him. I'm a math guy. I've always been a math guy. It fascinates me. He's sitting there. He's got his El Producto cigar going, which stunk like crazy. Probably a cup of coffee or a cup of tea. And he's going through just with a pencil, handwriting everything down. He was got his calculator from like 1972, literally, that I think he still has to this day. I'm pretty sure he still has the same calculator. He's 84 years old. And he's going through all of that. And I said, Dad, what is all of this? He's like, well, these are deductions. What's a deduction? He said, well, the government gives you money back for doing certain things. I said, like what? And he happened to have the charitable stuff. He's like, well, I give money to charity and I get to reduce my income tax. And I'm like probing him of it. And he gives me this specific example. He says, let's say I'm really rich. He said, it's not a big deal for me, but let's say I'm really rich. And again, this is pre-Tax Reform Act of 86. I said, okay. He said, if the really rich person gives $100,000 to charity, they're in the 90% tax bracket. And the government's going to give them $90,000 back for making that contribution. And I went, okay. But they're still out the $10,000. He looked at me and just like this look of confusion. I said, basically, I wouldn't give money to charity just to get a tax deduction because I'm always going to get back from the government less than I gave out. And he nods, and he's got this nod, and his eyebrows go up. He nods, and I walk away, going tra-la-laing away, probably playing with my Star Wars action figures or something. And he must have sat there and went, what the hey? What the hey? How does he understand that? It just seemed so basic to me. So here's the deal. So you've got tax rates from 10% to 37%. 37% is the worst tax rate we have today. If you pay $1,000 worth of mortgage interest, the government will give you back between $100 and $370. Is that a good deal? No, it's not. It's an awful deal. It's okay to deduct interest on a mortgage if you need the mortgage, but just having a mortgage, just to have a tax deduction, doesn't make sense at all. It just doesn't. It doesn't compute. It's foolish to do so. Which gets me to, I'm going to jump around a bit. I'm going to go to number 6, which I'm now going to make number 5. It's number 6 on my notes. And I bump into this a lot every year. Is you're not getting anything when you get a tax refund. You didn't win. You didn't win a prize. You're getting handed back your own money. Stop getting excited. Now, I understand why we get excited. It's getting to that time of year where we're pulling coats out of the closet. Every couple of years this happens to you. I know it does. Used to happen to my mother all the time because she's always stuffing money in places just as she's getting out of this store and putting it in and this and that. Doesn't always go back in the wallet or the pocketbook or whatever. And you pull a coat out of the closet and you put your hands in the pockets. You pull out a $20 bill and you think, I am $20 richer. Do you think that the Andrew Jackson Ferry put that $20 in there? No, you put the $20. It's your $20. It was always your $20. So that money that you get back in April and you think this is a great country, it was your money to begin with. Now, if I don't want to get into you're giving the government a tax-free, an interest-free loan. I don't care. And if you like getting that refund because it funds other things, that's your vacation fund or things like that, that's great. But what I don't want you to do is think you won anything. The government is giving you back your money. You overpaid them and they're giving it back. It's like going to the store. And how many people pay with cash? I still pay with cash. I love cash. When I go to the store, usually it's Amazon these days, so I don't go to the store as often. But when I go to the store, I have cash and they hand me my change. It's the exact same situation is when you give the government money from your paycheck or your Social Security or your pension or whatever, and over time, over the year, they collect all that money. And then in April, you come back and you say, hey, I gave you too much money. Can you give me this money back? And you get it back. That's exactly what's going on. So be aware of that. It's not a bonus. It's your money. There's nothing wrong with getting it, but don't think like you're getting one over on the IRS. This one I bumped into just recently. Number 6, but it was number 5 on my list. And I don't want to cover it for too long because it's only a couple of people that may impact, but I want to talk about it, is the taxation of capital gains on your house. And I had this happen a couple times in the last month or two that really shocked me. That people were worried that they were selling their house and they had to go buy another house within 2 years in order to avoid capital gains on their house. And I went, wow, that's not true. But it could have been the last time you bought a house. If you go back, it used to be that that's how it worked. So you bought a house in 1975 for $20,000 and you sold it in 1980 for $50,000. And you had to go out and buy a $50,000 house in order to avoid capital gains, which was stupid in the first place. I'm sorry. I don't care who you are within reason. But your home shouldn't be subject to capital gains. And that's what we were facing is at some point, Congress realized, wow, boomers are going to start retiring and downsizing, and they're going to face these massive capital gains. And that's probably not a good thing. So we're going to change the law. And we're going to change it such that each person on their primary residence can avoid $250,000 worth of capital gains once every 3 years. I think it's 3 years. I'm pretty sure it's 3 years. Don't quote me on that. Look it up. But it allows you to just simplify that process. If you think about it, if you bought your first house in 1972, 1975, and you've bought 6 houses since then because you've moved around the country or whatever, and now you've got all these records, the IRS has no idea if you're correct or not with your capital gain. And they said, you know what, we're just going to make it simple. $250,000 per person. So a married couple is $500,000. Solves the problem. When was that enacted? That was part of the Republican contract with America. So you're talking the mid-90s. The law was signed by Bill Clinton. He takes full credit for it. He did nothing for it. I find that absolutely awesome about Bill Clinton. He was amazing at that. He came into office, he increased taxes, he did all of these things. He was going to change things. 2 years later, basically both the House and the Senate turn over, and they come up with this Republican contract with America. We're going to change these things to make America better. And they did. And Bill Clinton's got two choices. He can either veto everything and then get overturned on vetoes, or he can sign it and embrace it. And he signs it and embraces it. And everybody thinks he's a hero. And he is, because he did it. And I'm very happy. And Bill Clinton was just a master at that. The guy who orchestrated the whole thing, everybody still hates. Newt Gingrich. Oh, that guy, the Newt Gingrich guy. Oh, that Newt Gingrich guy. But I think it's his name, is you can't have a guy named Newt Gingrich. But he created all of that. Bill Clinton gets all the credit. I think that's fine. I'm happy that we got it. So what we look at is the capital gains on your house are very much simplified. There's still potential problems or issues with maybe if you've lived in a very wealthy community and you've lived there for a long time, even if you're married, you may still face capital gains on the sale of your house, even if you buy a house of equal value. So be aware of that. But that old system of rolling gains is all gone. All right, last one. And this one, I I think it's our paranoia as humans. We believe this. The IRS doesn't know nearly as much as you think they do. They just don't. They don't know, and they don't care. They only care when things pop up. So here's what the IRS knows about you: is they know what was reported on 1099s and W-2s and a couple other forms that are submitted to the IRS. And then they know whatever you sent them. And that's it. There's no big brother out there watching you. Is when your tax return goes in. And now it's a little bit different because just about every tax return is submitted electronically. They do a basic math check, make sure that the math is correct. And I remember back in the 80s, mid to late 80s, doing my own taxes. I did my own taxes. I'm like 18, 19 years old. I did my own taxes because I wanted to learn how to do it. It's like, no, I'm going to do this. I'm going to figure it out and do it right and go to my dad and say, hey, about this. And I worked at a trust company. I go to the tax department and talk to somebody there and say, hey, how does this work? Or what should I do here? I remember the capital gains form was awful. And I had a capital gain distribution from one of the mutual funds I own. And I had to go to one of the guys, Al, can't think of Al's last name. I loved Al. Al was a great guy. And he helped me through that of, you write it this way. This is how you do that. And it was great. That's when math was important. Math is less important. So the IRS is going to make sure your math is correct and it's all set. And then they're going to run your return through a couple of filters. There's a couple algorithms they use to see if anything seems unusual. For me, I get kicked out of the algorithm every year. So the way my compensation works at my firm, which I own, it's always been this way. I don't know why it was this way. It was this way when I had a business partner. It was this way when we worked for another firm. It's just the way that I did it, and I just have never changed it. Is my income is somewhat variable, so I'm never sure. So I take a regular monthly stipend on a W-2 basis, and then I take my quote-unquote bonus, which is the real pay I take at the end of every quarter. Get paid all of the bills for the quarter, then get paid the bonus. So my regular W-2 is, I think I declare after taxes and retirement plan contributions, I don't know, $1,000, $2,000 of income. That's it after that, because I withhold so much in federal income taxes so I can avoid paying quarterly income taxes. I hate remembering to pay the quarterly income tax payments. So I just pay it through my W-2. Well, that just makes the algorithm explode at the IRS, and they don't get a paper copy of your W-2 anymore. It's all electronic, and they don't believe me. So every year in June, I get a letter from the IRS. We don't believe you. Submit your W-2. I have to mail them the W-2. Then they look at it, and then if I get a refund, I'll get my refund. So I don't get my refund until July or August because they have to look at it. So the IRS is looking at all of these things and just making sure that all makes sense within their algorithms. And if everything makes sense, other than being bumped for a random audit, they're never going to look at your tax return again. Ever, ever, ever. They don't care. They're assuming you're doing things correctly. So going back to my dad, 1982, 83, 84, with all of those receipts, it's important to have them correct. But the IRS is not double checking his math to make sure he added up how much he gave to, Holy Cross Church. They're just not. They don't care unless he gets audited. And people really freak out about those things. And I'm here to tell you, chill out. First of all, the IRS doesn't care in terms of there's no Snidely Whiplash type character waiting to get you in trouble. Do not cross the IRS. I have had a situation where through a fault of theirs, and a former accountant, I crossed the IRS, and they were brutal. They were wrong, but they were brutal. And they were far less than apologetic when it turned out it was their mistake and not mine. So you don't want to mess with them, but they're not out there looking to tie you up. They're not looking to jam you up or to cause you grief. They just don't care. So why do I say all of this? Is people get so bent out of shape that they don't have every single receipt and every single thing. Do you have your checkbook? Do you have your checkbook that proves that you wrote out those checks for whether it's business expenses or whether it's charitable contributions? Yes. The IRS is going to require, if you get audited, statements from those charities. They're going to require it. Do you need it to file your taxes? No, you don't. If you know your number is right, that's all you really need to know for that time. Nobody is looking to jam you up. Now, you want to make sure you maintain those records, save your checkbooks or your statements, or use them electronically, so you can go back and prove it anyways. But don't get overly worried that the IRS is going to get you in, that you're going to get in trouble with the IRS because you didn't dot every I or cross every T for them before you filled out your tax return. So that's it for this week. I hope you learned something. I hope I was able to dispel a myth or two on taxes. There's a whole bunch of these. There's investment myths. There's estate planning myths. I should start pulling some of those together to get kind of an idea. So hopefully you learned a little bit. If you can do me a huge favor, hit that subscribe button. Make sure that if you haven't already, on whatever platform you are, make sure you leave us a review, just so other people that are scrolling through and saying, hey, what is this? They can see what's going on. Finally, if you found something useful, do me a favor, share this. Is usually within the podcast app you have, there's that little square with the arrow coming out of the top of it. Hit that button. You can share by text or something like that and say, hey, this was something that you may want to listen to, whether it's your Uncle Joe or your coworker or your spouse or whatever. We're always looking to spread out this information as much as possible. So that's what I have for you this week. Careful on your taxes and stay safe out there.
Thank you for listening to Your Telecom Retirement with your host, Dennis O'Keefe. Please click the follow button to be notified when new episodes become available. You can find information for Dennis, our guest, or resources mentioned in today's episode in the show notes. The information in this podcast is for educational purposes only. The content is not intended to be a substitute for professional investing advice. Every individual situation is different. You should consult an expert before making any changes to your financial situation. For more information, please see our disclosure information at www.successfulmoney.com.